This podcast is general in nature and hasn't taken your circumstances into account. It's important you consider your personal circumstances and speak to a financial advisor before deciding what's right for you. Any general tax information provided is provided as a guide only.
Hi, Shane.
Hi, Me. Good to see you here.
So when I was thinking about what we should talk about today, I feel like it's kind of impossible to avoid the elephant in the room, which is basically tariff news. Every morning we wake up in Australia with a new piece of tariff news. And the latest one, as of the time of recording, looks like that the delayed tariffs on Canada, Mexico, and additional tariffs on China, that looked like it were reverted last month. It looks like they are back on again.
Well, it seems that way, but of course, by the time anyone's listening to this, it could have gone in a different direction. And that's the thing with Donald Trump. He chops and changes. He wants to be unpredictable. That's the art of the deal. I guess the problem for us as investors is that we know it creates a lot of uncertainty, not just for us as investors, but also for ordinary people out there, particularly those in America. A lot of uncertainty at present around how much they're going to be paying at Walmart for their products imported from China and products imported from Canada and Mexico. Businesses that get a lot of part of their supply chain, some of their goods come from across the border in Mexico or Canada, so that creates uncertainty. And then you've got the DOGE, the so-called DOGE, Department of Government Efficiency, and that's creating lots of announcements, lots of uncertainty for federal public workers in the US. All of these things can create what you call policy uncertainty. And so one might say, well, you know, we want lower taxes, we want less government spending, we want less regulation. But against that, if you've got too much uncertainty around all these sorts of things and services being cut back and uncertainty about tariffs and prices, that can actually work in the opposite direction and create a big negative impact, which we may be starting to see right now.
I thought it's interesting that the goal of all of these tariff announcements, one, it can be a negotiating tactic, which certainly has kind of worked so far. And the second goal is probably to offset all the tax cuts and all the deregulation, basically all the cuts to government revenues that Donald Trump is definitely going to enact, just as he promised on the campaign trail. But the issue with tariffs is might be this additional uncertainty that it created, and we actually did see that playing out in the data flow from the US over the past few weeks. So you see PMI, so basically surveys on purchasing managers from different companies. Both services and manufacturing companies have seen a massive decline in sentiment. You also see inflation expectations from the consumers spiking to basically the highest level, even higher than the level back in 2022 when we had, the start of the war. So it seems like this sentiment issue is probably going to affect the actual hard data later on, even before the tariffs get enacted.
I think that's the big worry for investment markets, for share markets, because you can look through a bit of noise, but if there's going to be a real impact on the economy and on profits, it's not so good. And of course, investors also hear what's coming out of the US administration under Trump and others. Scott Bessent, the Treasury Secretary, said, oh, well, it might take 6 to 12 months. Things can get worse before they get better. Donald Trump's talking about more tariffs. We've got the steel and aluminium to come in a week or so. We've got, he's talking about pharmaceuticals, autos.
Agricultural as well.
He's talking about agricultural, asked his government to look into that. He's talked about copper. He's talked about reciprocal tariffs. All of these things ahead of us, obviously causing a lot of uncertainty, and that's where markets start to get worried. So my view has always been you could have this, we could easily have a 15% plus correction here. I know that sounds scary, but if you look back through history, those things haven't been that unusual. So you could see a rougher ride here, but then hopefully the fall in share markets itself, along with backlash from ordinary Americans, starts to put pressure on Trump and they back off a little bit. Time will tell how much longer we've got to go through this, but it seems to me like the volatility will continue for a while yet.
Well, I thought your investment mantra is turn down the noise. Should I just basically turn off the news, not read any of these if you think that the backlash will help keep a guardrail on Donald Trump?
Well, there is an argument to do that. I often think if I look back through my time in employment, which is 40 plus years now, there's been a lot of noise. The 87 crash, I could have, through the 87 crash, if I had choice in my super, I didn't back then, you just had your super where it went to. you couldn't go online and move it somewhere. But these days you can go online, and a lot of people start worrying about a crash after the crash occurs. Famous saying from a guy called Lynch, I think Peter Lynch, head of Fidelity, one of the major equity funds back in the 70s or 80s. And he once said that people started worrying about the 87 crash after the 87 crash. That's when everyone gets nervous. But if I'd switched out of shares after the 87 crash, given all the noise, I would have made a big mistake. So in many cases, I think it is better for people to just look through it, look through the noise, make sure you've got a diversified portfolio, make sure it's not just all loaded up in Tesla or which seems to be going to the moon. I mean, you showed me that funny meme the other day, which made me think we often talk about Bitcoin going to the moon, and the moon is always up there, but at occasions it's down there. It's down there. It could be the same for Tesla shares with Elon Musk's constant appearance is probably not helping brand issues around Tesla. But you can go through this period. It is often better for long-term investors, people who have a long time to go before their retirement in particular, to say, well, I'm not going to focus too much on this sort of stuff. It's going on. It's going to create volatility, and I'll just stick in there for the long term. I reckon one of the best things for me was the 87 crash, because it meant for many, many years I was buying shares in my super on a monthly basis, or whenever they took the money out of my salary into super, at a much discounted price. And that helps in the longer term. Obviously, if you're in retirement or close to retirement, slightly different issue. Depends on your risk tolerance, the size of your balance, whether you can ride it through, and that's where you need to seek advice.
Yeah, I agree. I think every student in Australia should actually learn the magic of compounding in high school rather than just economics students.
Well, that's right. I still don't understand this. We used to have a situation, when I went to high school in the 70s, big chunk of kids did economics.
Yes, it used to be the most popular HSC subject in New South Wales, just after English and maths, which were basically compulsory.
Now it's down the bottom. Hardly anyone does it. But it is very important to get yourself financially literate. And I think that starts at the school level, and that's why people should be learning things like the magic of compounding. That's how you grow your wealth over time. If you're getting 1%, say getting 4% in bank deposits, and your bank deposits, you watch how that grows over time. It will grow over time. It will get bigger, but not radically. You won't become rich doing that. But if alternatively you've got your money in a growth asset like property or shares, where you can look forward to maybe 8%, 10%, numbers historically have been around those sorts of levels, sometimes much more. I think 12% if you go back to 1900 in Australian shares. If you get that sort of number, that return will grow on itself. $100 one year becomes $112 the next, which then becomes $125 or something, and so on. It grows in an exponential fashion over time. You get the setbacks, that's the price you pay for having those higher long-term returns, and they're painful, but they tend to be every 2 years out of 10, as opposed to every year. And so you've got to ride through that noise to make the most of compound interest.
Yeah, but going back to markets a little bit, I think...
And we got a bit distracted there.
The assumption that shares rise over time is also underpinned by, I guess in your time, baby boomers were basically driving the deregulation of markets. There was actually productivity growth throughout that period, which basically underpins the rise in share markets over time. But is this time different? Are all the cutbacks from the US gonna matter for productivity growth? I know this is like a passion topic of yours. If they force everyone back into the office, would that actually drive down productivity and maybe, have some negative impact on productivity in markets over the long term?
Well, there's a whole bunch of issues in that. I do get worried in Australia that we've seen a lack of what I would call sensible economic reforms, and that has meant that we're seeing much lower productivity growth. In fact, productivity in recent times has been going backwards. I think a lot of Australians hear about the cost of living crisis, and household disposable income in real terms per person has actually gone down. In fact, you just updated that graph today after the GDP numbers came out. So good news, GDP growing better again. Per capita GDP was up after 7 quarters in decline. But if you look at household disposable income in real terms, adjusting for inflation, and per person, it's had a little flick off the bottom, but still well down from its highs. And a lot of factors behind that. Wages didn't keep up with prices. But the problem is, historically, if we want decent wages growth in excess of inflation without generating excessive inflation, which I would call, say, wages growth around 3.5% to 4%, something like that. To get that, you really need decent productivity growth. We want output per person to go up. That doesn't mean we all have to work harder and longer hours. Ideally, we want to work shorter hours, but we've got to use more machines and work more smartly. And we saw that for many years coming out of the 80s and 90s economic reforms, but that's slowed right down in recent times. Unfortunately, our tax system is not working properly. We have ridiculous taxes like stamp duty out there. We pay too much in income tax. Baby boomers, soon going to start retiring. There's going to be a lot of them in retirement, and they're going to be relying on all these millennials and Gen Zs to pay the income tax to make sure that you've got enough money in health and welfare and all those sorts of things to support the people as they retire. That's not a good mix. We should be relying more on the GST, less on income tax, less of a burden on Gen Z and millennials. We've over-regulated the labour market in Australia. The list goes on. We need to look at these things. We've got government spending in Australia running at record levels. That's taking money away from the private sector. Sure, we like things like NDIS. I think that's a great initiative. We need to spend more on defence. But if we're going to do these things, we've got to do it in a sustainable way. And that's what worries me a little bit. And the work from home thing, I think that was a great thing. Not many good things came out of the pandemic, horrible period. But one thing it did show is that people can work from home in certain jobs, and technology allows that. And I think the key is to get the balance right there. If we go to one extreme or the other, if everyone's just working from home, you don't get the benefits of collaboration and workforce culture that you get by coming into the office. But if everyone comes into the office, it jams up the streets. We get traffic jams. It's bad for the environment. We all have to live near the CBD or the city or our place of work. You don't have that flexibility. It means less women will participate, and we've seen a huge rise in female participation. There's huge negatives with that. So I think that the key to me, is making sure we get the balance right. Not 5 days in the office. If people want to come in 5 days, fair enough. And not 5 days at home. There should be a balance worked out there. And that is the key in all of this. So it does worry me when politicians are saying, well, all the public servants have to come back 5 days a week. That's macho US stuff. I think we need to think about what is the best approach from a holistic point of view. Participation in the workforce, men and women, productivity, environment, housing, all these sorts of things have to be thought about when setting the mix appropriately.
There's this famous saying by Paul Krugman, productivity isn't everything, but in the long run, it's almost everything. And I actually think that's quite true. And actually, I think it's basically also underpinning our assumptions that shares would still rise over time, maybe not this year, but over the medium term, especially with all the improvements from AI. For example, maybe, 30 years ago when you were writing your GDP note, you would need another person checking all your typos. That would take another 30 minutes before you can send it to the markets, whereas now I have Copilot and Microsoft Word doing it for me. So to me, that's a minor improvement in productivity already, and it probably will still deliver more productivity, not just to Australia, but over the world as well in the next 5 to 10 years. But why is it still so low over the last year in Australia? We had ChatGPT now, we have Copilot now. Why is it still declining?
Look, we've debated this one endlessly. Diana and you and me, and what's driving it. And there's a debate amongst economists out there. I think part of it is companies maybe hoarding labour. There was those shortages a few years ago, so they're hanging on to workers longer than perhaps they should have. That's maybe a degree of hoarding in there. Big factor is, of course, the growth in the public sector relative to the private sector. So we've seen public sector share of GDP go to a record highs. The numbers you put out today on the chart up to
28%.
Yeah, 28% almost. So that's a record high. So that's taking resources away from the private sector, and that includes workers. And you've seen strong growth. Some measures show 85% of the employment growth over the last 2 years. I don't think it's as strong over the last year, but 85% over the last 2 years has been in what they call the non-market sector or public sector. And so if you've got less, just mathematically, productivity measures to be lower in the public sector than it does in the private sector. I don't know why, it just does. There's measurement issues as well in all of that. But if you've got more resources going into the public sector, which is somewhat less productive, than the private sector, then your measured productivity numbers won't look as healthy. And maybe that's what's been happening in Australia.
I think this issue is especially bad in the construction sector. So basically, we had a boom in government infrastructure projects. And actually, today in the GDP data, you see that the ABS pointed out that within the construction industry, there is still very high material costs. There is still a shortage of construction labor. And I guess this is a more of a longer term thing. There's still quite bureaucratic approval process, which basically drives down productivity in the construction sector.
Yeah,
so,
those
so
stats
that's driving housing affordability as well.
It sort of worries me. Initially, the theory was we've got a shortage of workers, the building materials costs are through the roof. And then it looks like it's more chronic than that, because the shortage of workers is alleviated and the building material issues have gone down a little bit. Not as bad as they once were. But yet we still can't build as many houses as we used to. And the home builders say that it takes them many more months now to get a home built compared to what was the case in, say, we had this unit building boom across Australia in 2015, 2019. That's when we used to do this thing called the crane count the number of cranes all over the cities. And it was just amazing how quickly those things were going up. Yes, there were quality issues and we had to get on top of that, but the delays now are immense compared to that period. But that period was about the closest we got to the current government objective of building 240,000 dwellings per annum. So we've really got to go back to that time, speed it up, make it easy to build properties, slow down the approval processes and all these sorts of things.
Yeah, actually last week I had the opportunity to listen to the head of the Productivity Commission, and she actually said that
Daniel
the
Wood.
the doubling in the construction time is especially bad for units rather than detached houses. And most of this increase in duration of building is actually due to getting approvals and documents to comply with the government requirements.
Well, that's how crazy it is. And this is why I sort of have some sympathy with DOGE. What do you call it? DOGE. You know, they just want to sound sophisticated, don't they? I'll call it DOGE. It's the same with Ethereum and Ethereum. I keep calling it Ethereum, and I'm told it's Ethereum. Anyway, I have some sympathies with that. You know, there's too much regulation out there. It slows things down unnecessarily. But I go to other countries and I kind of think, well, you know, how come everyone can do this? And maybe we're too over-regulated in Australia. It's like a nanny state in a way. You know, you go to beaches and you got to read the sign intently to work out what time of day your dog can go on the beach and what month it is and all that sort of stuff. These things seem over the top to me. But by the same token, you don't want to throw the baby out with the bathwater. So you've got to get the balance right. And hopefully we're in Australia, so if we do go down a path of removing unnecessary regulation, which I think we should do, we do it in a sensible, considered way, not do it all in a few months and do bad things as well as good. I guess we better wrap it up. This has been good fun. Lots of negatives in there regarding productivity and tariffs in the US, which are causing lots of angst. I don't know, lately I get up every morning wondering what Donald Trump has done lately. You know, the Zelensky thing, you know, the tariffs, all sorts of stuff going on. But there are some positives out there. We've seen Germany, the German election, the centrist parties in Germany getting together to boost defence spending and infrastructure spending, which is a positive thing for Germany after many years of not spending much. We're seeing interest rate cuts still continuing. We're seeing inflation coming down. So it's not all negative. But I think we do have to allow, as investors, we might go through a bit of a rougher patch before things finally settle down and start trending up again.
Yeah, so turn down the noise.
Turn down the noise. Thanks, mate.
Thanks, Jane.
For more info on Shane and Diana's podcasts and reports, head to the Insights Hub at amp.com.au.